Hello again. We have been doing a lot of simulations where we start with a mean and a standard deviation and use some kind of a random number to get some kind of an output. And today what I'd like to do is look at the returns of a stock. So let's say that, call it daily stock returns. And let's say that I don't know if the stock's going to go up or down, so the expected change in the stock is 0. But let's say that it's got a standard deviation. There's some uncertainty. It could go up, it could go down. And by putting a 2 in there, remember among friends we use our 68% rule, and that means about 2/3 of the time it's going to be within a -2 to a +2% return on any given day. If we use a random number here to say it could be on the low end, could be on the high end, then we can calculate an output like we've been doing. Get that mouse out of the way. Norm.env. This is where we take the random number. Help if I'd use equals, wouldn't it? Random number for our probability, the mean, and the standard deviation that I just talked about. And now every time I recalculate, which I can do by hitting F9, I get a new output, or in this case, daily return. I'm going to do an Alt-HAR to align those to the right. I want to change that to a percent with Alt-HP and show a decimal place with Alt-H0. There are buttons up here for those of you on a Mac or who just don't like keyboard shortcuts. But this is how we get to a daily return. And we could format inputs and outputs, but I'm going to change this up a bit. What I do want to do a few times is hit F9 and just get a qualitative idea. Are most of these numbers kind of falling between that -2 and +2% return? And they seem to be. Let's come down here and let's say this happened for a few days. Let's say we had day 0, 1, 2. See how many days we have room for. Let's come down to about 10. And then let's say we had a random number for each different day because we don't know if it's going to go up or down. So each day it could go up or it could go down. So a random number of 0.5 would mean it didn't change much. A random number really close to 1 would be more on the right side of that distribution, the attractive side. And a random number closer to 0 would mean we're on the left side or the less attractive side. And so then if we had a return for that day, I believe what we used above was norm.inverse of whatever that probability happened to be for that day. And then we need a mean. I'm going to put $signs on that so I can copy it down. And a standard deviation. And so that could happen several days in a row. These are uncorrelated. Neither one depends on what happened before. And if we were tracking what was going on to the price, let's say our stock was $100 on day 0. I guess we didn't really have a return on day 0, did we? So we could say that it was whatever it was the day before times 1 plus the return. And let me go ahead and format these with an Alt-HP, Alt-H0. And each time we get a random number. If it was below 50, if it was below 0.5, then our return was negative and the price went down a little bit. If it was above 0.5, the return was positive and the price went up a little bit. If it was way below 0.5, it was close to 0 in this case, then the return was pretty negative and the price went down quite a bit. So you see where we're going with this. I'm going to select these cells, hold down Control and select these cells. Do an Alt-N-D for scatter plot. And then I'm going to choose this one. And what we have here is the price per day. So let's go ahead and label our axes. I'm not great about this, but I'm a stickler on exams for labeling your axes. So this would be our price and our day. So if we start at 100, we get these random numbers, our price can walk around quite a bit. If I hit F9, we'll get a completely different set of prices that could happen. If I hit F9 again, we continue to get a different set. Notice Excel is really good about rescaling this y-axis to fit our chart. However, that makes it kind of hard to look at for me. So what I like to do is click somewhere on these buttons, right click, and say format that axis. And I'm going to come over here. If yours doesn't come up on this bar chart, click on the bar chart and set your axis bounds. I just happen to feel like 85 to 115 will be good. And then if you wanted to reset those to automatic, you could click on these buttons. But look what happens now. Every time I hit F9 and it recalculates, this thing is not rescaling for me. Sometimes it's nice to have a chart rescale, but if you want to look at how things are changing, it's very confusing for me to have that chart rescaling all the time. So if I can hit F9 many, many times now and get different ideas of which way this price may walk. And so what we've done is looked at returns that are normally distributed. And what the experts will tell us is that in general, stock returns are normally distributed. Now this is not enough for me to draw a histogram, but I'll bet if I had a couple hundred trading days, I could get a nice chart. So what I want to do is extend this down to 252. That's how many trading days there are in a year. At least that's what Google tells me. So I could just go ahead and copy this down all the way down to 252. But when I do, look what happened to my chart. It's still looking at row 10. So I'm going to undo that, and I'm going to show you a trick. We did this trick in a previous video. I'm not sure that I spent much time on it. Notice that if I were just to come in here and insert an entire row, that chart is now looking down to row 22. Previously, it was only looking down to row 21. So if I came in and inserted, let's see, I want to get to 252 trading days. So I've already got 10. So if I inserted 242 rows, I'm holding down Shift and I'm hitting page up and page down until this little yellow number over here that says 242R, 242 rows. Now I could right click and choose insert, but I like to control Shift plus and it automatically inserts. Now look what my chart's doing. It's looking all the way down. And in a previous video, I think I told you I don't know an easy way to fill in these numbers. If I do a control down, it takes me down to row 262, and you can see those two rows that I pushed down there. And I told you I didn't know an easy way to do that, so I said equals that plus 1. I did a bunch of copying and stuff like that. Since then, I've thought of an easy way to do that. I'm going to type my name. Probably my name's not the best thing. I'm going to copy, Control Shift down arrow, Control V to paste. And now I'm going to come back up to the top and get a couple of these to tell Excel, hey, I'm counting by ones. And I'm going to double click on this box, and that gets me up to the control down arrow, by the way, 252. So this is how many trading days there are in a year. Now I can come back and double click on this. I always like to get at least 2 rows when I double click. I was working on a project in a company one time, and for some reason there was a number like this in that cell, and I just clicked on one row, and when I double clicked, it started counting 1, 2, 3, 4. It's kind of a long, boring story, but it led to really big problems. And so after that, I always learned, you know what, if you're going to use that little trick, get 2 rows to let Excel know you didn't want to start counting from 1. You wanted all those to be 1. So now, watch when I double click, then it continues that line of 1s. The ones over here don't mean anything. That was just a sidebar. No extra charge for these extra little pieces of wisdom. So I think I'm going to need to rescale my chart so we can show an entire year's worth of where that random walk might go. By the way, if I haven't said it in the video yet, people call this approach a random walk because we're saying that stock price can just walk up or down based on this normal distribution that we're sampling. And that's how we predict the stock price. Last 2 points look a little off, so I'm going to go make sure I didn't do anything weird. I did. I've got this formula that's still looking up at row 19. So after all that sidebar about how to do this correctly, what I could have done is just taken some formulas that I trusted, do a Control-C, Control-Shift-Down, Control-V, and that fixed those last two. So now here again, when I do the F9, I can get a random walk. Another thing that the experts tell us is while these returns, these daily returns, are normally distributed, this ending price is log normally distributed. And if you think about it, that makes sense. There's a whole lot of upside, but there's only $100 downside, right? That stock can never go down $101 based on our model, but it could easily go up $200 or $300. And so that should tell us to expect a log normal distribution on that last price. So let's check this out. Let's see if these returns are really normally distributed. Now, we're not going to be too rigorous in our statistics, but one good way to check it would be to look at a frequency distribution of returns. So if I thought they could be negative 10%, negative 9%, and so on. And then we came in here and highlighted this row and said frequency. And notice I did get an extra, I'll speak to that in a minute, but I got an extra cell there. So the frequency of this data, comma, in these bins, Control-Shift-Enter, says, yeah, only one of your data points was less than 7% down. Only another one was less than 5%. But when you get into this 0 range, quite a few of them are in that range. So if we made a picture of this, I think last time we did an Alt-N C1 with a column. Now look what Excel did to me this time. It thought that both of these were data, were series that I wanted to plot. You can't really see the blue, but it's down here. I have 2 series in this chart, so I need to right-click on this thing and select the data. I don't want this series 1 at all. I'm going to remove that. And for series 2, I'd like it to have some labels. So I'm going to edit them and look at this label range right here. And say OK. Again, we're not into charts in this course yet, but this is a good way to fix it and see that, okay, that actually looks like is a little bit skewed. But if I hit F9 again and recalculate all these, let's see what this chart looks like. I'm trying to get in a good habit of doing my axis titles. So this would be frequency, I guess. And this would be daily return. And I don't really want a legend on there, so I'm going to turn the legend off. And let's call this daily returns. Now remember, I said the experts tell us that these returns are normally distributed. We said that they have a mean of 0 and a standard deviation of 2. So if that's true, we should expect this chart to have a peak, a mode around 0, and a median around 0, and it should be pretty symmetric on both sides. Now we only did 252 samples, so if I hit the F9 key, I'll get 252 new samples. Okay, it's relatively symmetrical, and so on. The more I do this, the more I convince myself it seems to be relatively normal. We're not going to split hairs in this class on statistics. We just want to see if we can generate some things and see if they're pretty symmetrically distributed. And if so, we'll believe the experts that these are normally distributed. Now, how would I find out if this final price, the price at the end of 252 trading days, is normally distributed or log normally distributed? Well, I'd have to calculate that price a whole bunch of times. So while this is bin and frequency for daily returns, what I would like to get is a bin and frequency of ending prices. So I'm going to have to collect a bunch of ending prices. So let's do a Monte Carlo simulation. And let's do some number of iterations. And let's do a ending, I'll call it ending price. I'm looking for this price after 252 days. So the ending price is going to be equal to, I'll come over here and do a control down. It's going to be equal to E263. And the iterations, you can tell I'm building a data table on a blank cell here. I'm just going to drag this down and get about 1,000 iterations. And I think we agreed I agreed without you guys this semester that we use a yellow cell there to indicate our blank cell. So when we select these, I think we also said this would be an output, and these, they're not really inputs going into our model, but they're inputs going into that blank cell. So when I select enough cells to get all the colored cells and only the colored cells, and I do an Alt-A, W-T for table, tab because I have column inputs, and I want to put them there in that blank cell. When I hit OK, it's going to put each one of these numbers in that blank cell. All of this is going to recalculate. There'll be a new price random walk over here, and it's going to capture where that random walk ended up, and it's going to put it in this cell. Then it'll put a 2 in that cell and capture it and do it again, and a 3 in that cell. And so we'll get 1,000 different possibilities of where this price might end up after 252 trading days. And we'll need to hit F9 to make that clean up. And there we go. So the first time it did that, the stock price almost doubled. The second time it did it, it was down about 40%. The third time it was up, down. We had a really good outcome there. But I'd like to see what all these look like kind of in aggregate. So where I did a histogram over here of daily returns with bin and frequency, this time I'm going to do ending price with bin and frequency. And I don't know what bins to use, so I'm going to highlight this and look down here to see what the min and the max are. So I'm going to click on that, do a Control Shift down, and out of that 1,000 iterations, the minimum was $35 and the max was $340. So I think I'll start at $20, $40. I don't know why I'm leaving a blank cell there. And we'll take that up to about 400. And then we'll use this frequency and say equal frequency, find the data array. So look at all those 1,000 possible ending stock prices we could have had and sort them into these bins. Control Shift Enter. And it looks like most of the time the stock's going to end up around $100 to $120. Could get down below $40. And we might even get lucky and get up over a couple $100. But let's see what that distribution looks like. So one easy way to do this, take this chart, hold down the Control key, and drag it, and notice that there's a little plus right next to my mouse. When I drag that down, it copies it. If I let go of the mouse first, if I let go of the Control key, it moves it. If I press the Control key and let go of the mouse, it copies it. Now, just like a formula in a spreadsheet, when I see these colored things that this chart is looking at, I can move them like so. Well, at least I can move the blue one, which is the Y data. If I want to move the X data, I'm actually going to have to click on this guy. And then we'll talk about charts some other day. But that way I was able to copy that chart, keep the frequency. And instead of daily return, I want that to say ending stock price, and ending price. Okay, and there was one other thing that bothered me on this, that I've got this blank cell down here. This frequency thing is a little bit quirky. There's a long, boring history of the frequency function and why it has to go down one more and why it calculates what it does. Let's handle that in a class discussion or maybe a future video. So I'm going to click on that chart and adjust both of those ranges up. Okay, let's see if the experts are on to something here. If they're right, then we'd expect the daily returns to be symmetrically distributed around 0. That means each day we could be up, we could be down, and it's about as likely either way. But that ending price has a lot more upside than it does downside. So I honestly can't remember from statistics if we call this skewed right or skewed left. The long tail is to the right, but the mode is shifted to the left. Either way, it's skewed, and you know what? I'll look at that and agree that that's probably log normal. If I want to see a few different versions of that picture, I can hit F9, rerun that Monte Carlo simulation, and I see that, yeah, consistently, I'm convinced this is log normal and this is normal. And we have now exhausted everything that I learned in statistics class. But we've learned how to do a few things. We've learned how to run a Monte Carlo simulation. We've learned how to do a random walk to forecast a stock price. And we've learned how to gather up either those daily returns into bins that we can draw a histogram of, or gather up many different simulations of that final stock price outcome and draw a histogram of that. And then we can convince ourselves that the experts are right, normal distribution, log normal distribution. Where we're going to go from here in the next video is say, can we use this to value a stock option? So I will see you in the next video.